We at Hall Capital are really disciplined in terms of sticking with investing with the very best. The way that we completely view the world and build portfolios is with long-term returns in mind. And I think you have to actually have the belief in your ability to make judgments and do it.
It seems that Katie Hall couldn't have ended up anywhere but Wall Street. There was her aptitude for math and her choice for a final project in school.
I wrote my thesis on an explanatory pricing model of Treasury bill futures. I mean, come on, really.
After studying at Princeton and Stanford, Hall spent over a decade working in risk arbitrage.
I know how hard it is to be great at any sector of investing, whether it be venture investing or risk arb investing or global equity investing.
In 1994, as the risk arbitrage market dried up, Hall moved into money management, starting Hall Capital to manage the portfolios of wealthy families, foundations, and endowments.
What I had then, and I think we have now, is sort of an independent perspective.
Today, Hall Capital is one of the world's largest firms of its kind. It manages about $50 billion in capital and has 200 employees.
We have the capacity and the scale to be a world-class investor, but we have a scale and size that permits us to have very close, boutique-like relationships with our clients.
I'm here with Katie Hall, who is the founder and co-chairman of Hall Capital Partners, which is one of the largest women-founded firms in the money management world. Is that right?
That's correct.
And when you started this, did you realize you'd be one of the biggest firms that was started by a woman in the money management world?
No, not at all. I mean, I think it was one of the beginnings is really about just setting up a good firm and building something that would be the best in the business.
So exactly what does Hall Capital Partners do? It's called an OCI by some people, which is explain what that is.
So an OCIO is an outsourced chief investment officer, which actually isn't really, in my opinion, the greatest term. And it really is sort of setting up as opposed to having an in-house chief investment officer. We really act as the chief investment officer and the investment team for our clients, who are foundations, large pools of family capital, endowments. And we really work very closely in partnership, managing investment portfolios.
So if somebody says, I'd like your services and I want to have an outsourced CIO to kind of manage my money, what kind of rate of return do you tell them you can get for them? Is it a 10% rate of return, 15%, 5%, or it depends on what their risk profile is?
Returns are completely dependent on asset allocation. And then, of course, what are the choices that you're making within that asset allocation? So it's really a blend of what are the different components, whether it be fixed income, equities, hedge funds, private equity, venture capital. What we do with our clients, we don't start from the presumption that there is a right answer for an asset allocation. We really spend a lot of time trying to figure out what's the right roadmap, what's the right plan for that particular situation, and then go from there.
So you don't actually sit at a trading desk and trade for your clients, no?
I don't.
So what you do is you pick good managers. What are you looking for in good managers? People that have a long track record, or people that are starting out fresh and they're really hungry, or what are you looking for?
I think there's a couple of things that cut across all asset classes that really are markers of superior investment managers. One, and what we're looking for. One, we actually start with the opportunity set. We only want to be investing in places that we think on a go-forward basis have attractive return potential. We then really are looking at people, firms that have the capacity to take advantage of whatever the opportunity set is, that have the track record, have the ability, have the experience, have worked in that field, that have a very clear, disciplined investment approach. That are themselves as an organization are set up to actually capitalize on that opportunity set. We look a lot at incentives in organizations, like how people are rewarding themselves to see if they're set, that just the overall organization is situated in a way that permits them to actually increase the odds of success.
So as we talk today, inflation is very high. It's likely that interest rates are going to go up and continue to go up for a while. Does that make you nervous about the next year or so in terms of investments? Are you changing your strategy because of what's going on in the inflation and interest rate world?
You know, our core investment strategies and the way that we completely view the world and build portfolios is with long-term returns in mind. And that is the prize. That's what we're looking for, is long-term compounding returns. So we tend not to adjust kind of for shorter-term gyrations. Now, that being said, I do think we are at a point of really fundamental change. I mean, think about it. It's been a decade of basically free money with a whole bunch of consequences of that, including some probably severely inflated valuations in certain sectors. You could argue that it's been, 40 years of structurally declining interest rates, and that has come to an end. And I actually do think that is a really important thing. And we've been thinking a lot about positioning portfolios, not just now, but over the past several years, about how to position portfolios to actually have the resiliency and be positioned to participate in growth over the going forward 5, 7, 10-year return.
Now, as we talk, there's a war going on in Ukraine, and it's obviously changed people's perspectives on many things, including the energy supply chain and food supply chain. Does it affect the way you advise your clients, or it doesn't really have that much big of an impact?
You know, in the short term, no. But I think that's another really important global factor. You know, we think a lot about just the broad context of which portfolios are built and in which we're investing. And I think that the issues that are created by rising energy prices, rising food prices across the emerging markets, across Africa, across the Middle East, it's a very severe and potentially destabilizing set of factors. And so just as we, think about in a completely different set of vectors, the impact on sort of economies, on portfolios of sort of geopolitical tensions with China or relationship with China, so too I think that the changing stability of governments and sort of the mapping of that has a potentially a really significant impact on just how economies will look going forward over the next decade.
The economy in the United States seems to be doing okay, but there's some people that say there might be a recession a year from now or so because we're raising interest rates, and in the end, that will probably slow down the economy. Are you worried about a recession?
I think that we are definitely in for a period of, if not an actual recession, at a minimum, a re-rating of valuations that is sort of related to increasing rates and slowing growth. I think that the parallels to what we are seeing to 1999, it's different, but there are some definite analogs, is something that we're very mindful of. And it's getting back to this idea about focusing on the long term and making sure that our portfolios are situated to participate in that and not being overly distracted by short-term volatility, but yet being mindful that there is definitely shifts that are happening in the overall landscape and we need to position against that. I think this is an environment that will lend itself to some real innovation and some real system change.
It's called Galvanized Climate Solutions. It's a firm co-founded by Katie Hall and billionaire Tom Steyer to raise money for the fight against climate change. The goal is to invest billions in companies and organizations working to curb carbon emissions. Some high-profile investors have joined in, such as billionaire Mark Benioff and Emerson Collective, an investment philanthropy founded by Lorraine Powell Jobs. Hall and Steyer see a need for what they're doing. Galvanize says that over the next 30 years, the world will need to invest about $4 trillion a year in energy transition technologies. Spending now is about $800 billion, which gives Hall and Steyer a big gap to fill. One of Galvanize's first investments was the routing company. It's bringing the ease of ride-hailing to buses and vans. Now, you're also involved in climate change-related issues. And with your old friend Tom Steyer, you have built an alliance to kind of invest in climate change-related companies. Explain exactly what it is.
So when we created the company, we really had this vision that there was both a huge need and opportunity to be able to marshal probably substantial amount of capital to orient it, private capital, to orient it around helping to accelerate climate solutions. This is a critical decade that we actually have to make real progress. What we're doing with Galvanize is we are building a platform with quite deep expertise across science, across technology, across policy, across communications, across finance, that will then support a number of different investment strategies, from venture capital to public equities to everything in between. All of these will be strategies that will be oriented around investing against, again, solutions and generating, we believe, market returns.
Is it a for-profit venture?
Absolutely. We think that it's important that capital come into the system, that capital invest for climate solutions, and that actually get appropriate returns for that, so that we actually can then attract more capital to help really create that proverbial flywheel effect.
So Tom Steyer is known to many people as somebody who ran for president and who's also a big environmentalist, and so you've known him for a very long time.
Tom and I were analysts at our very first job together at Morgan Stanley, so we have known each other since 1979.
And so today, when people talk to you about the environment, you basically say to them, this is an important issue that they really need to deal with, and your new organization will help deal with it?
Exactly. But it's actually something I think that we are seeing. The environment, excuse the pun, has really changed. We're seeing the capital markets are actually demanding that companies actually make progress on climate solution. We're seeing investors look for that. We're seeing actually customers of businesses demanding different kinds of activity. We're seeing employees. We're seeing people that want to work at companies that actually have a much more explicit mission about that they're trying to accomplish. So I think this is an environment that will lend itself to some real innovation and some real system change.
Do clients come to you and say, look, I want the best rate of return I can legally get. I'm willing to have you look at ESG, but that's not my main thing. My main thing is rate of return. Or people say to you today, ESG is very important to me and rate of return is secondary.
Yes, but I actually think that's still the wrong framing of it. That still implies that you actually have to expect to give up something to have a full incorporation of environmental, social, or governance characteristics. I just don't believe that. I think that actually the best companies are those that are making the most effective use of their human capital, their physical capital, their financial capital, and they're companies that are thinking about them actually will probably be the most successful companies and maybe the most interesting investments.
Let's talk about how you got into the business. So when you were a little girl, I assume you didn't say, I want to be a money manager.
No, I did not.
Okay. So where did you grow up?
So when I was younger, my family lived in Minnesota, and then we moved to Rye, New York when I started high school, and I really consider Rye my hometown.
So you must have done reasonably well in high school because you went to Princeton, right? And what did you study at Princeton?
I took a winding path there too. So I started as an engineer and found it a little nonverbal for my taste back in the day. So I switched to English, and that was too many words. So I ended up majoring in math track econ.
So when you graduated from Princeton, what did you do then? You say, I want to be in the financial world?
Well, I was looking for a job. I actually had I wrote my thesis, oh my goodness, on an explanatory pricing model of Treasury bill futures. I mean, come on, really. So I was actually looking for something in finance, and I actually looked at some jobs on futures exchange. I ended up getting a job as an analyst at Morgan Stanley.
And you went to Stanford Business School?
I did went to Stanford. Stanford was much more appealing to me. It had a much more flexible curriculum. You just didn't have to approach things in just one way. Cases, for example, it was a much more flexible approach in terms of what you did. And I took a very flexible approach to business school.
So did you say, I want to start my own money management firm when you were at Stanford Business School?
No, not at all. I actually came back to Morgan Stanley, and I worked for the next 10 years in risk arbitrage. So I worked at Morgan for 2 years in risk arb. Then I moved to California to join my partner and friend, Tom Steyer, as he was setting up a company then called HFS Partners that became Farallon. And then in '89, established a risk arbitrage joint venture with Montgomery Securities.
But you also were in the buyout business for a while. Were you not a partner, or were you at Hellman Freeman?
I was a partner at H&F, but it was really because of the adjacencies with HFS partners. So my day was really focused on the risk arb side of the business.
All right, so you're in risk arbitrage, you're working at Hellman Freeman. When did you say, I've had enough of working for somebody else, I'm going to go start my own firm?
In 1989, where I formed this joint venture for risk arbitrage with Montgomery Securities. So that I was like, I said, well, it's time for me to be in charge. So I set up that business, truly with like the shockingly terrible timing. So think October 1989. That was when the United Airlines buyout blew up, which we got through it fine financially, but that literally stopped merger activity on a dime for about the next 5 years. So I had this sort of small risk arb partnership that I'd set up that we were, but there was just not that much to do. So I sort of toiled away for the next 5 years, kind of waiting for the environment to change. And then it was really in '94 when I was talking with Warren Hellman, who was the biggest investor in our partnership, and as an incredible friend and mentor. He said, well, why didn't I work with his family the way that I was working with another large family already? And I basically said, why not? That truly wasn't my opening business plan. So I ended up liquidating my ARB partnership and rolling the general partner into the beginnings of what Hall Capital is today.
You were the chairman of the board of Princeton University, your alma mater, for 10 years.
8 years.
8 years. Were you the first woman to be the chair?
I was.
What was that like? How much time does it take to be the chair of the university board at Princeton?
We know there's a difference between being sort of chairs of organizations that are in turmoil and chairs of organizations that are incredibly well run. And Princeton has a very effective and well organized board. And I was fortunate enough to be chair with two just truly stupendous people as presidents, Shirley Tillman and Chris Eisgruber. Be patient and be willing to invest against the crowd.